funding your lifestyle from the day you retire until the day you turn 72. On this week's edition of WealthWise. I'm Chuck Vickery with Elevate Wealth Advisory. Let's look at what this means for you. Thanks for joining us today. This month we're talking about making smart financial decisions from age 20 to age 90 and how to obtain and maintain financial independence and fund your lifestyle in a way that you lose the least amount of wealth to taxes over your lifetime. I mentioned that accumulation phase starts when you start working and it ends when you get your last paycheck. When you get your last paycheck, we start transition, and transition lasts through age 72. At age 72, we start spin down our distribution. And that means living off your resources for the remainder of your life. We discussed this in detail last week. And when you're gone, we have legacy, what you leave to your heirs. Today, let's talk more about transition. Transition begins when you get your last paycheck, and it ends when you turn 72. This is where the magic happens. It is where you can fix things now before you run out of options. The objective here is to design a strategy that minimizes your tax liability over the long term, not just for this year, but for the long term. If you haven't already, now's the time to build a plan for the family to lose the least amount of wealth over multiple generations. You have to realize that retiring and starting Social Security are two entirely separate decisions. You can postpone taking Social Security until age 70. You're not forced to withdraw money from your retirement accounts until age 72. So there's a short window of opportunity once you retire to make substantial changes that will greatly improve your future tax situation. People are tired of paying taxes. Those who have not yet started Social Security or withdrawing money from their retirement accounts are so happy that their taxes are low. Their goal is to lose the absolute least amount of dollars to taxes in 1 year. Unfortunately, they fail to realize a huge tax bill is in their future. They should change their goal to lose the least amount of wealth to taxes over their lifetime. Estimate your taxable income. During transition, we have to make some proactive decisions. For many, taxes are low when you enter transition. As we have a progressive tax system, as your income increases, so does your tax bracket and your tax burden. You've paid taxes for years at high rates. Now you're paying almost nothing. Once you estimate your taxable income, you can make educated decisions about what you should do. Couples should get the adjusted gross income up to at least $109,000. Why do I want to do that and pay taxes? It's great not paying taxes, but take advantage of the low tax rates while you can. When you start receiving Social Security and are forced to withdraw money from your IRA, taxes come roaring back at much, much higher rates. Develop a tax rate bracket strategy. For a couple, the standard deduction is between $25,000, almost $26,000, and almost $29,000, depending on your age. The standard deduction is the amount Uncle Sam says you need to live on, and you can live on it totally tax-free. The next $20,000 of income is taxed at only 10%. The next $63,000 of income is taxed at only 12%. Take advantage of these rates now. Do not waste the opportunity, because after this, the tax rates go up rapidly. We can show you how to project your future income and see what your future looks like if you do nothing. And most people are surprised by their future tax liability. This is a great time to end deferred income, annuities and government savings bonds, and deferred compensation. When do you want to pay taxes on deferred income? When your tax rate is the lowest. Now's the time to do that. If you don't do it now, not only will you pay higher taxes, but your heirs will as well, as deferred assets do not receive a step-up in basis. The theory here is to liquidate an asset that has received deferral during your high tax years while you're in a low tax year. If you need the money for living expenses, use it for that. If the proceeds are not needed for current income, they can be repositioned to be more tax efficient, and in the future receive the step up in basis. It may be possible to go from something that is forever taxed to something that is hardly taxed. Review the purpose of your life insurance. If your death creates a problem that can be solved by cash, then maybe you need to continue with your life insurance. But if your death creates an emotional loss but not a financial loss, then maybe the insurance isn't needed. Could the cash in the policy work harder for you someplace else? Would your budget be better if you didn't have to make those premium payments? Things to think about. Once you've looked at these things, then it's time to explore Roth conversions. I had a client in the office the other day, and I asked him to bring in his tax return. He was so happy. I didn't pay a penny in tax last year, he stated. I replied, that's a shame. Let's see if we can't do something about it. What are you talking about? I don't have to take any money out of my retirement plan. I haven't started Social Security. We're just living off the money that we got when we sold the business. That's already been taxed. I didn't have to pay any taxes, he stated. We then discussed the fact that he was wasting the opportunity to use these 10 and 12% tax brackets. I suggested that he volunteer and take $100,000 from his IRA and convert it to his Roth IRA. We calculated the federal taxes would be about $8,000. When he turns 72, he'll be in a much higher tax bracket, and the tax on $100,000 dramatically higher. As you know, Roth IRAs are funded with after-tax dollars. Once in a Roth, there's no tax on the interest, the dividends, the growth. Money comes out tax-free in retirement. It passes to your heirs tax-free, and you aren't forced to take it out at any age. So you aren't forced to spend these assets. And there's two ways you can add to Roth IRAs. If you're working, you can make a contribution if you qualify from an income standpoint. The other way is you can do a conversion, where you convert a traditional IRA into your Roth IRA, and the amount you convert is subject to taxation. The more you convert, the higher the tax. But while in transition and in a low tax bracket, convert some of your IRA each year. Pay the low tax now at a low rate rather than paying it at a higher tax rate in the future. When you do this, the amount converted is subject to taxation. The more you convert, the higher the tax. But while you're in transition and while you're in a low tax bracket, convert some of the IRA each year. Pay the low tax now at a very low rate rather than paying a higher tax rate later. This does a couple of things. It reduces your future required minimum distributions because you have less in your IRA, which helps lower your future tax bills. A lower future adjusted gross income helps lower the Medicare tax and may make less of your Social Security taxable. It also allows your children and grandchildren to receive a tax-free asset. And if the money is needed in the future, guess what? It's available, tax-free. Another way to lower your RMD is to realize income before age 72. Even if you do not need the money, fill up that 12% tax bracket. Withdrawals prior to 72 will lower your RMD because you'll have less in the IRA. Withdrawals during transition can be repositioned to create dividends and capital gains that are taxed at a much lower rate and receive the step up in basis. In conclusion, transition is where the magic happens. It's a time where you have options to fix things now. The problem with transition is to get the most out of it, you must proactively volunteer to pay more in income taxes. The winner is not the person who pays the least tax this year, but the one who pays the least over their lifetime. Thanks for watching. If you have any questions about anything we've discussed, please feel free to reach out to us. We created a 5-page workbook, Strategies for Retirement Transitions, that I used as a basis for our discussion in this series. If you'd like a copy, please email marketing@elevate-wealth.com and we'll gladly send you a copy. See you soon.